Welcome to the deep dive. Today we're digging into Arvind Ltd, the big textile and advanced materials player, and their frankly quite surprising Q2 FY26 results.
Yeah, surprising is the word. Because if you rewind just a few months, the whole narrative was about India being in this advantaged position. Geopolitically speaking,
Yeah.
everyone expected that China plus one shift to really start kicking in, sending volumes their way.
And then bam, it's just flipped. Our sources show a complete 180. Suddenly, India's facing what the company itself called the most disadvantageous position. Why?
Tariffs, big ones from the U.S.
Exactly. We're talking a 50% tariff level mentioned in the documents, which might be the highest hitting any of the major competing textile nations right now. So think about it. Rivals in, say, Vietnam or Bangladesh, they just got a huge price advantage overnight.
Which brings us to the core puzzle we want to unpack for you today. How on earth does a company facing that kind of headwind, its highest tariff exposure ever, not just, tread water, but actually report its highest ever quarterly revenue? We're talking 2,371 crore. And it's not just revenue, EBITDA up 13%, profit after tax up a massive 70%. It doesn't immediately compute, does it?
Not at all. So our mission here is to figure out the mix of, let's call it strategic maneuvering and just sheer operational grit that allowed them to pull this off.
Okay, so let's first get a handle on just how big this tariff shock was. You mentioned the consolidated revenue, 1,371 crore. Now, the direct hit, their U.S. business exposure was almost 500 crore.
Wow, okay, so that's, what, roughly 21%, a fifth of their total sales directly impacted by these massive tariffs.
Precisely. And the actual cost they had to absorb just in Q2, the estimates point to around 23 crore. That's a significant chunk of change to swallow in 3 months. About 7 crore of that was from the advanced materials side, the rest from textiles.
So how do they deal with it? I mean, you can't just pass a 50% hike onto your customers, can you? They just walk.
Right, and management knew that, especially with their long-standing partners. So the core strategy was selective support. They offered discounts, but, and this is key, it wasn't charity.
There had to be a catch.
There was a trade-off. The sources are clear. Any support or discount was given in exchange for higher volumes and, crucially, a stronger commitment for future business. They were basically saying, we'll help you absorb some of the shock, but you need to commit more business to us long term.
Okay, that makes sense. Protect the relationship, lock in future volume. Even if it hurts the margin a bit now, it keeps the machines running and the customers loyal.
Exactly. It's about strategic stickiness, making sure customers keep relying on Arvind for the whole packaged quality delivery, vertical integration stuff that maybe competitors, even with a lower price, couldn't guarantee as consistently.
But hold on, giving discounts and eating 23 cores in tariffs? How do you still end up with 13% EBITDA growth? Sounds like margins should have tanked. Do they just, train customers to expect lower prices forever?
That's the fascinating part. And no, they didn't tank the margins completely. Look, the reported margin improvement was pretty muted, only 41 basis points year on year, less than 0.5%. That is the effect of the tariff headwind showing up. But behind the scenes, management was all over what they called structural and lasting savings. This wasn't just cutting travel budgets. It was, deep operational efficiencies, cost optimization programs really bearing fruit.
So they were basically pumping water out as fast as it was coming in.
That's a great way to put it. They managed to internally offset almost that entire euro 23 crore tariff hit. If you do the math, if you adjust the reported margins and add back that tariff cost, their underlying profitability would have been nearer 12%.
Which lines up perfectly with their medium-term guidance. Okay, so the internal discipline basically neutralized the external shock on the profit line. That's impressive.
And that internal strength really rests on what's become a dual-engine business model for them. This seems critical to their resilience.
All right, let's define those for everyone. You've got the traditional powerhouse, integrated textile and apparel, or ITA. That's your denim, woven fabrics, garments.
And then the newer high-growth engine, the advanced material division, AMD, think technical textiles, composites, that sort of thing.
And both are firing.
Both are firing. The sources say each is now running at a quarterly rate of over 2,000 crore. And importantly, both are growing consistently in the high teens, think 15 to 18%. This balance is key. AMD is generally higher margin, less tied to fashion cycles.
So it acts as a kind of buffer when the textile side faces volatility like these tariffs.
Precisely. And looking at the ITA side specifically, the operational volumes show they were running incredibly tight. Garmenting, for instance, crossed 10.7 million pieces. That's up 17% year on year.
And that wasn't just market growth, right? They had to work for that.
Definitely. The report points to winning new customers, really pushing capacity utilization, and leveraging their vertical integration, controlling more of the process from fiber to finished garment.
And the fabric side.
Same story. Denim hit its highest volume in years, 15 million meters, up 16%. The woven division, near its highest ever volume at 35 million meters. They were basically running their plants flat out. The demand was there and they could meet it.
Okay, so ITA was maximizing output. What about the other engine, AMD? How did that hold up?
AMD growth actually rebounded nicely, up 15% year on year. And the drivers here are interesting because they show that diversification benefit. They saw key defense orders restarting in human protection.
Things like body armor, uniforms.
Exactly, stuff that had maybe been paused. And alongside that, a big pickup in demand for pultrusion, that's their composites business, used in things like infrastructure, industry.
So completely different demand drivers than fashion T-shirts. Defense and industrial demand kicking in just as consumer-facing textiles hit a wall. That's the diversification working.
That's the hedge in action. Okay, stepping back from the quarterly numbers, there was a big strategic move too, the demerger of AMD.
Right, that finally went through. It's now its own wholly owned subsidiary, Arvind Advanced Materials Limited, AAML, effective September 1st, 2025. Why do that now?
Well, the rationale given is flexibility. Housing AMD separately creates a dedicated vehicle. Look, advanced materials is a different beast than textiles. Different investment needs, different management focus. Investors value it differently.
So it's about letting AMD run faster, potentially attract different kinds of capital or partners down the line, maybe even a separate listing eventually.
That's the thinking. Management said the current focus is just growth and profit. But yeah, it absolutely creates that option for the future. It could unlock significant value.
Makes sense. And speaking of strategy, they're not just relying on the U.S. anymore, are they, given the tariff situation?
No, definitely not. They're actively pivoting geographically. The U.S. is still important, obviously, but the documents highlight a real push, especially in AMD, towards new markets. Australia, the Middle East, the U.K. are specifically mentioned.
Smart risk management. Don't put all your eggs in one tariff-heavy basket. And this prudence seems to extend to spending, too.
Yes, they explicitly chose to defer some non-critical capital expenditure just to keep more cash on hand, maintain liquidity flexibility.
How much did they pull back?
They revised the full-year CapEx plan for FY26 down to the 450 crore range. It shows they're being cautious, preparing for potentially rougher seas ahead.
Okay, so financial discipline, strategic pivots. But what about the really long game? Are they just managing the present or building for the future too?
That brings us to sustainability. And this isn't just, greenwashing. It seems core to their long-term strategy. They're making some serious investments.
Like what?
Well, the big one is commissioning India's first supercritical CO2 dyeing facility. That was about a 25 crore investment.
Okay, break that down. Supercritical CO2. Sounds like science fiction. How does it work?
It's pretty advanced. Basically, you pressurize carbon dioxide until it enters this weird state where it acts like both a liquid and a gas. In this supercritical state, it's apparently an amazing solvent for dyes. It carries the dye into the fabric really effectively.
And the benefit is?
Massive resource savings. We're talking potential cuts of up to 76% in water use, 67% in energy, and maybe 90% in chemical usage compared to traditional wet dyeing.
Wow. Okay, that's not trivial. That's a game changer operationally and environmentally. Lower costs, better eco-credentials.
Exactly. And they're pushing on circularity, too, working with a U.S. company called CRRC to use more next-gen recycled fibers. Plus, their net zero targets, both near-term and long-term, just got validated by the Science Based Targets Initiative, the SBTI.
So they're aligned with that 1.5-degree pathway to net zero by 2050.
Correct.
So for you, the listener, why does this matter? It seems twofold. One, it gets them ahead of regulations like upcoming EU rules demanding recycled content.
Definitely. And two, it makes them a much stickier partner for big global brands like H&M Group, who are increasingly demanding this stuff from their suppliers. It future-proofs their relationships and revenue.
Okay, so looking forward then, what's the immediate outlook? Q3.
The guidance for Q3 seems cautiously positive. They're saying the order book is healthy, which fits the usual pattern. The second half of the fiscal year is typically stronger.
And the growth engines.
AMD is expected to keep humming along, targeting 18–20% revenue growth. On the textile side, garmenting is aiming for mid-teen volume growth, and they're still investing in capacity there.
Right, you mentioned capacity expansion. How much are they adding?
The plan is to cross 45 million garment pieces this year and then push towards 55 million next year.
That's a big jump, almost 25% over 2 years. But wait, if the tariff pain is expected to continue.
Ah, good point. And yes, the estimates suggest the tariff impact might actually increase slightly in Q3, maybe hitting 25-30 crore for the quarter.
So they're expanding capacity into potentially worsening trade conditions and maybe a slowing U.S. consumer market. Isn't that risky?
It is a risk. Management seems to be betting that their internal savings and efficiency gains will continue to accelerate and offset that higher tariff cost. They're essentially banking on their operational discipline to keep them on track.
But that's a bet, right? What about further out? Q4? Beyond?
That's where the real uncertainty kicks in. Management themselves admitted Q4 is just too far out to call given all the external variables. If these tariffs stick around indefinitely, customer behavior will change eventually. Those short-term volume commitments won't last forever.
And you have the risk of the U.S. consumer just stopping spending as much, right?
Yeah.
Inflation plus tariff-hiked prices hitting the shelves.
That's the other big worry. If U.S. demand falters significantly, all the internal efficiency in the world can't create orders that aren't there.
So what's the company's mindset? Hope for the best.
Quite the opposite, it seems. They explicitly stated they're operating as if the future is going to be difficult. That mindset, that internal pessimism, is what allows them to push through tough cost cuts and maintain discipline now.
So if things improve, great, it's an upside surprise. If they don't, they're already braced for impact.
That seems to be the approach. So wrapping up, this deep dive really shows resilience comes from that combination. A balanced business model, aggressive diversification products, geography, customers, and that relentless internal focus on optimization to absorb shocks.
And here's a final thought for you to chew on. The sources mention something interesting. Both Arvind and their customers are kind of operating under the shared assumption that at some point certain aspects of the tariff will go away.
Right, like maybe a trade deal gets worked out or politics shift. This shared belief acts as a sort of temporary glue, stopping customers from making drastic, permanent shifts away from India right now.
But what if that assumption is wrong? What if the geopolitics stay messy, the trade deal never comes, and these tariffs become the new normal for Indian exports? What does that mean for global supply chains in textiles and materials long term? Arvind's shown they can react and pivot.
But the real long game might be won by whoever figures out how to permanently serve global demand outside the shadow of an unpredictable U.S. market that could fundamentally reshape how and where things are made.